Sustany Capital, and we've already done this twice. And the first time you didn't like it. The second time I didn't like it because it didn't record. So we'll try this again. We have a new producer on set, and we'll see how she does. So we're doing security tokens, right?
Let's do security tokens again.
Yeah, let's do that again.
Can't do enough security tokens.
Yes, because I know that you rarely share your opinion with people on what you think about security tokens, so it'll be good to hear it firsthand right now.
Yeah, I'm very opaque about my opinions.
Yeah.
Very subtle.
All right, so you created a handy dandy PDF.
Yeah. Strong opinions weakly held. I think that's a motto I can subscribe to. I don't know who coined it. But I like it.
All right.
So
cool.
As usual, let's start with just some taxonomy.
All right.
So what's a security? We got our debt instruments, and most people don't realize that the banknotes that they carry around in their wallets are debt instruments. They're typically in this country Federal Reserve notes, and that's probably a podcast we should do on another day, because there's a lot of confusion around what currencies are and what money is.
Yeah.
And I think in the context of blockchain-based solutions, that has been kind of expanded upon, but at the same time, a lot of people use it so synonymous. So I think it's worth doing a separate show about that.
Okay.
Other debt instrument, the normal ones that people would know would be bonds, and then you got your equities, the most common one being common stocks or stocks in general. And you got derivatives such as forwards, futures, options, swaps. And so those are your securities you should know about. And then one thing that I always like to start with, also when we do our meetups, as you know, is to just go back and revisit how we understand blockchain and how we understand tokens. And I think there's still also a lot of misunderstanding around what blockchains are, what tokens are. So, whereas every token is a smart contract, not every smart contract is a token. And I think that is a very important lesson to learn in the context of blockchain-based solutions. What do I mean by that? If we take our most common token, an ERC20-based token, so a token that was created based on this particular API on top of the Ethereum blockchain, then what that means is that the standard, this protocol that this API delivers, will allow you to trade this token on exchanges that support that standard, and that's basically all of them that are out there, because it's the most common standard, and will also allow you to carry the private keys in whatever wallet supports that standard. Again, because it's the most common standard, most wallet will support it. And then lastly, it will allow you to transfer these particular tokens peer-to-peer. And that is the final quality then of having an actual protocol, meaning having an actual token. So whereas you can obviously create a number of proprietary smart contracts that do something on the blockchain, right? And they might partially use ERC20 qualities, so i.e. I can store a private key in my wallet, which is really not a good term, because wallets in the context of blockchains don't actually store tokens. It's oftentimes very confusing to novices, because they think they have tokens in their wallet, right? Because you don't, you have private keys in your wallet, right? So that's why wallet is really not a good term in that context. But
yeah, that confuses a lot of people on what that is. They think that they're carrying around their actual Bitcoin in that wallet or whatever.
What you don't, right? So you don't lose that wallet and lose the token. You lose the private key to manipulate the token. And if you still have a backup somewhere, then you just recreate the private key, and so you'll be able to moving these particular tokens or coins around, which is also another important distinction to make, which a lot of times users still to this day, even if they have been in this space for some time, confuse coins and tokens are not the same. Coins are the native asset of a blockchain. So a Bitcoin with a lowercase b on the Bitcoin uppercase b blockchain is a coin, but any ERC20 created token is a token. The
token.
native asset on Ethereum is Ether.
Ether is a coin.
And hence Ether is a coin in that particular context. Again, it's like there is, I don't necessarily think there's overall agreement on that, but it's a very useful distinction to make. And if someone has a better distinction to make, please offer it up and we can derive to some useful vocabulary here. Because otherwise, if we don't do this, we can't really have a useful discussion. If people keep using terms indistinguishable from each other, currencies versus money, tokens versus coins, blockchain versus DLTs, then we can't really have a useful discussion. So
yeah, it's very muddled.
Yes,
people just kind of keep throwing words willy-nilly and not really knowing what they're saying. Like people describe the blockchain as Bitcoin.
And so any science, and if you want to refer to the blockchain space as science, has its own language, right? So it has its own vocabulary, and this is still somewhat new, so it still needs to be formed, and we're trying hard to get accepted vocabulary out there. But specifically in this context of security token, it's very unfortunate that people have jumped to use that term, because a security token from our perspective requires a security token protocol on a public mainnet of a blockchain, because otherwise you're negating all the functions that are interesting about a token. It's like I can't transfer it peer-to-peer. It's like whatever sidechain function, whatever other smart contract function the developers designate for this particular instrument still need to be checked with that sidechain, which in most cases means it's a database, right? Mm-hmm. So if it's not part of public mainnet, then really that's what that is. And then if you think this through, specifically in the context of if you are the issuer, so if you the entity behind that token that's relating its asset, its company, its real estate, whatever it is that this particular instrument is trying to transfer. If you are attaching this to that particular instrument and the underlying technology goes away, so if that sidechain that's providing the functions of the smart contract go away, you have a problem. Right, so all of a sudden, all your shareholders, all your token holders, right, can no longer act efficiently with that token if they can act at all. So then you're left doing deep due diligence, which is what we did, on everybody who is pretending to provide a solution in that space. Yeah. And once you do that, that picture is just not very pretty, right? Because the obvious one being all of these companies are startups, and most startups fail. Yep. A lot of these entities don't look around, they don't look towards other solutions in that space, and they are specifically, from an investor's perspective, what you're looking for is product market fit. So one part being the technology, the other part is this an offer that is going to be interesting in the future, right? So if there's one company that's offering that same function for free and another company is thinking that they will be able to continuously charge for this very significant amounts, then from an investor's perspective, you look at this like, yeah, I don't think that's product market fit if you're working under the assumption that for the next years you'll be able to charge $10,000, $20,000, $50,000 for this particular function that this other project is providing entirely for free, right? Mm-hmm. And what we've seen doing the analysis on all of these projects in that space, there's just very little peer review, and so that's what we're striving to do always. Do peer review on, hey, this is a particular solution. What else is in that space? How do you feel about these other solutions? Have you looked at those? And why do you think your solution is either better or more advanced than this other one? And that's not obviously not limited to the securities token space, but it's rampant in this particular space. Okay, but I digress, as usual. So I think what we should start with, what's the problem that security tokens, let's stick with this vocabulary throughout the cast, so I don't have to do my air quotes all the time. So everybody thinks of air quotes every time I say security token, please. So the near-term utility that we see, and we formulate this under the topic of RegTech, regulation technology, is really to mitigate things such as compliance costs, right? There's a lot of costs involved for functions that you can automate, and that's what smart contracts are really good at, automating functions that are somehow digital in nature. The second one, and that's where we figured thus far this instrument is not so good, as it's just creating primary liquidity or capital formation. Right now there's very few platforms out there that do this, and they simply lack allocators in that space that would actually be interested in buying these instruments. And unfortunately, because due to popular media and other people in the space that jumped the gun, tokens overall have gotten somewhat of a bad rap.
Yes, very bad.
Yeah. And so it's almost counterproductive for the time being to talk about tokens. That's what we found when we reached out to people in the community. And the other part is that the main problem really at the core that security tokens are addressing is this topic of liquidity. And there you would have to have secondary markets where you can actually resell this. Right? So to bring this into a particular context, if you see the offerings, private versus public listings throughout 2016 and 2017. So public companies raised $55 billion throughout that time, and private companies raised $470 billion throughout this. So private companies raised almost 9 times more, but because there's no secondary liquidity, it's harder to gain secondary liquidity. So once you buy this particular equity or this particular real estate REIT instrument, then you're facing a much smaller market, because obviously you can't just list it somewhere and sell it. You need to find your buyer. And so typically the way this is being addressed is with this business model called the liquidity discount, which can range anywhere between 10% on the low end and can go as high as 30%. So a medium would be 20. So if you just do very simple math, if you could actually reach liquidity for those private instruments, and even if the secondary liquidity was limited to an increase of 10-12%, this was amount to the same amount that public companies raised.
Wow.
During that time. So it's a big deal, right? So it's a lot of money, but right now there's just very little secondary markets. There's only 4 secondary market that actually launched so far. But then this other topic that I think is very important to understand is oftentimes security tokens are now being presented as the follow-on to ICOs, to quote-unquote utility tokens.
Yes.
So where, hey, there were ICOs, now we got STOs. That is a very unfortunate communication, because from 2 aspects. So a lot of these ICOs in the past, and you've taken part at some, we have taken part in some, we've run some. So a lot of these already did most of these trappings that you'll see with STOs, with security tokens. So they did KYC, they did AML. They didn't necessarily do the registration parts that may or may not be required, whether or not you subscribe to certain ideas of certain regulators, which brings me to the other topics, that utility tokens, so ICOs, aren't dead, right? They aren't dead, but one should very carefully construct those And these are definitely preferred. And what I mean by that, if it's not a security, yes, then in theory, if you apply all the useful trappings that the utility token under any pertinent regulation should have, that should get you a lower cost of capital. And so there are a couple of suggestions underway overseas, but then also some of the US states have brought forth some regulation. Wyoming passed regulations already in May last year, so if you check off those boxes, at least there you'll be safe, but then obviously under federal guidelines you wouldn't be. And
yeah, what happens? You do something with that's okay with the state, but not with the federal.
Yeah, unfortunately, the SEC and any of the other federal regulator won't adhere to whatever the states pass. So they can pass whatever they want unless it's adapted by all the states. We know this about the unfortunate topic of pot, right?
Yeah, I was about to say, it's the same thing. You can smoke it.
Similar, yeah. It's very unfortunate because some of those state regulators are obviously faster to adopt very useful regulation, but it's on average it takes a decade for all the states to then adopt these particular regulations. And as you know, there's very useful regulation coming out in California that pertain to privacy, and there it's the same thing, although there's other applications that we see that will probably have the effect, the net effect at the end of the day, because it's outwardly directed, that other companies will just have to adhere to the privacy regulation of California, because you don't know if you're addressing a Californian. So because it's a consumer protective mechanism coming out of that particular state, our state, it actually has a very positive effect. Unfortunately, that the same paradigm doesn't hold for a utility token.
Yeah.
But what I find very important to understand is the US is obviously not the most conducive environment to generate these particular instruments, and that's why ideally once you get into the path of, hey, I'm interested in creating an instrument like that, it's bad advice to just look to the US. Most of the time it's actually going to be more useful to look around the world, and it's a wide world, and with lots of different jurisdictions that are, most of them are more conducive to doing business, specifically in something that's blockchain based, because now we got blockchain in space, and blockchain is definitely not limited to any national borders. And at the end of the day, we always say blockchain is the solution to regulation, and regulation is irrelevant, basically. It's not the solution to blockchain, right?
Yeah.
And that's what we've seen in the past with ICOs, where ICOs then decided, okay, there's uncertainty around the US, so we're excluding US persons, private and individuals, and hence another very unfortunate communication pattern from regulators and quote-unquote lawyers in this country is always the SEC is going to start regulating tokens, they're going to start regulating ICOs. That's always wrong, semantically wrong.
Yeah,
because
they can't.
No regulators, doesn't matter if it's the SEC or anybody else, regulates technology. They only get to regulate their citizens. And I keep saying this until lawyers in this country and regulators in this country stop saying that they're going to regulate ICOs or STOs. They do not get to regulate.
No.
Say the truth. Tell the truth. We are regulating our citizens. That's all you get to do. And that, if you're honest in that communication, will get a very different response from people that are being regulated, right? Because then it's like, you can think about this, do I want to be regulated, right? If it's if it's being put like they are regulating technologies, which they don't, it's a very different animal than if you formulate it as, oh, I'm going to restrict your freedom to choose whether or not you want to engage with this particular technology. That's an enormous difference, right? And it's kind of another sleight of hand trick that not only regulators but also lawyers use to justify what they're doing. Because if that wasn't the case, it would become more obvious, oh, maybe I should turn to a different jurisdiction first. Right?
Yeah, I always hear the comparison to people taking their money and going to Vegas. You can take your whole life savings and go to Vegas. There's no regulations against you doing that and blowing your whole life savings, but they regulate what you can and cannot invest in.
Yes, I mean, I think that has become very obvious to almost everybody by now.
Yeah,
that shouldn't be the case. There's new legislation being proposed around that topic, where other people can also become quote-unquote accredited investors. But still, unless you address the real problems that people create with their money, that's such an insignificant number of people, because specifically in this particular case, it's so complicated to actually partake.
Yeah.
And it's never, has never been, and probably will never be what these legislators throwing around that mom and pop are getting into this business. They don't. It's utterly confusing, and a lot of these projects are super technical. It's like that will just put people off. They read this as like, oh my God, I understand. I don't understand the first 5 words.
No,
so,
you have to be a lawyer just to read the.
Yeah. So I would find it way more helpful if you explain everybody that's buying a lottery ticket that, hey, it's more likely you're going to get hit by lightning twice today than you're winning the money that you put back into this nonsense. Same with Vegas or anything else that's actually gambling. So there we need the education, and that's really the point. I mean, you don't make people smarter by regulating them. You need to educate them, and there's very little education, and that's rampant, specifically in the US. I found.
Yeah, land of the free.
Land of the free. Yeah. So. So I don't know if it's even helpful, but if you look at the landscape that people are being exposed to in terms of the security token topic, there's this entire myopia, and most of this is based on the ideas it has to fall into certain US security regulation exceptions. So that's typically your regulation D, but then also to some degree regulation A plus and regulation S, and then you've got also this regulation CF crowdfunding thing, the Jobs Act. But this discussion has been beaten to death by now, and it's not actually helpful. I mean, there's limited utility to be had. I'm not negating that, but it has very little, if anything, to do with security tokens.
Yes.
So it's regulation technology in the context specifically limited to the United States. And here's a call to action to anybody listening to that: create something that's international. Okay. And we just talked to someone yesterday in this particular context, and they've been doing the international setup for some time, not in the context of tokens, but we are evaluating this right now. And at that point in time, that's where the discussion should be starting, right? If you want to actually advise people in the space to create a digital security of sorts, then this should be your starting point. Your starting point shouldn't be, hey, we got these couple of exceptions here in the United States. That's not a very helpful starting point. Right? Even if you happen to be in the United States, well, other countries have other regulations, and supposedly whatever you're building that is a blockchain-based solution is not ever going to be limited to the citizens of the United States.
No.
And if it was, then from our perspective, it's not very interesting.
Yeah.
And so you're almost, to a degree, you're almost anchoring your project, and you don't allow it to even to succeed in a way. And the more we discuss this topic, the more in our opinion, becomes obvious that this US myopia will not help anybody. And it's very important that we pull this back and look at some international solutions. But even if you don't, right? So even if you don't, you create something that's US myopic, then you're never done in essence, right? So you create your security token, right? And then you have constant compliance, obviously, associated to that, right? So i.e. there's some laws that if you have more than 2,000 shareholders, you actually still have to register and report as if you were a public company. So this typical tenet of a token that you have, let's say, 16 decimals, and you can divide it, which was part of and always is part of the sales pitch, actually doesn't hold true, right? You're confined to that particular number. Otherwise, you have to register it and still report it. So you're still running into that same scenario. And that's why it's so important to first check whether or not you could actually create a utility token versus a security token. So it's not a great sales pitch. So, but let's say you created one, then if you overcome this idea, okay, is there enough liquidity out there, meaning are there enough people that are still interested in buying some form of token, then what's the cost of doing this? So you need to likely pay a broker-dealer if you need to have someone in between that brings this to market. So you're looking at anywhere between 3 and sometimes up to 7% cost of that. And there's other scenarios for investment banks. Investment banks are not really interested at this point in time, it seems, as far as we can tell, getting involved. And then the last one is this usual crowdfunding scenario. But crowdfunding also oftentimes seems to be misunderstood. It's back to 1999 where people had the impression of, hey, I'm going to launch a website and people will just come. There's 1 billion people on the web, so probably 1 million show up at my website. No, that's not how that works. You still have to drive traffic and pay for marketing. So whatever number you want to put on there, if it's 5, 20%, 50%, but you can probably, if you're savvy, you can probably get away with a 20% cost of capital. That's a lot of money.
It is, yeah.
So, but that's the money that you need to have to actually sell your security.
Yeah, you got to make sure that you have that set aside.
Yes.
For that. Marketing is very important.
And for some reason, some people seem to forget that you still have to do this and still have to market that.
Yes, you do. Now, I know that there was some people that I was going to do a show with when they were the ICOs. They were afraid to do a show with me because they thought that was it was against the regulations of what a security or a utility or whatever it was at the time. They couldn't market that, right? Is that?
Yeah, likely. I mean, it depends on what kind of contract they had. But yeah, a lot of these people went afoul of SEC enforced regulations, and it's not. People always say SEC regulations. SEC doesn't get to make regulations; they get to enforce them. Okay.
Yeah. They don't make the regulations.
I see this all the time. It's like SEC compliant. There's no such thing. You're compliant with the law. You're not compliant with the SEC. Okay. You're compliant with the regulator. They are the enforcement agency. No, they don't make laws. Yeah. We got the separation of, I wanted to say state and church, but you know, separations of powers. Yeah. That is, I think, very important to understand. So basic legal fundamentals are either poorly understood or poorly communicated, which is not helpful for discussion here. But so once you actually got this listed, but to your point, yes, these people likely needed to be registered with the SEC or FINRA as broker-dealers if they actually took a fee at the end of the day from that sale.
Oh,
so if you do that. Right. And if you don't, a few people went to prison for not doing this.
Yeah, I've heard that a lot of people are getting in lots of trouble.
Yeah, or at least getting fined. I mean, again, it's also, yeah, it's
they're making examples of people.
Yeah, that's mostly it, in my opinion, because it's. I mean, what's really at the end of the day, the question is always, what's the harm, what's the culpability, right? And as a registered financial advisor, so you have certain responsibilities, and you have to check that this particular offer actually holds up according to the marketing that you're doing. And I assume that those people didn't do that.
No.
But I mean, if you're exposed to a VC and you have this quote-unquote stamp of approval, and specifically if you are engaging with an old and established VC, they will do something that's way more scrutinous than any regulator ever would. Right? So every project that comes through our door, if it even passes the sniff test that we would look into it deeper, will go through way more scrutiny than any regulator will ever apply to any of those projects, because we do due diligence on the project, so on their technology, on their team, but then we also do due diligence on whoever they're using for their auditing, etc. If this holds up, and we have specific industry expertise, which you definitely can't say about any of the regulators. Right? So they're still making all the basic mistakes. They still don't understand, for the most part, based on what they're putting out there, what is a blockchain, what is a decentralized ledger, when is someone a custodian, how do you define custodianship? Because these things changed. What I mean by that, it's like in the past it was very clear cut. If you had your money, quote unquote, in a bank account, this bank is a custodian, and as a custodian, yes, you are obliged to fulfill all these regulatory parts, right? And you should be scrutinized, obviously, because
of course
they are in charge of your money. You just lost almost all control of your money, right? If they don't want to give it to you, you know that, right? Then the bank decides, yeah, I really don't like you sending $11,000 to this other person, then it's not happening, right?
Yeah.
You can scream and shout, and if it's Sunday, then it's definitely not happening, right? But the point here is that when we created new blockchain-based assets, this is smart money. You can program it so that now all of a sudden it's no longer as clear-cut. It's no longer that either you or this other entity has custody, but you can split it, right? So either you can set it so that, hey, there's two people that need to sign off on that, and one is this custodian that I determine, or there's two people on my side, me and my brother, or me and my mother, that need to sign off. That you can create a tremendous amount of other control mechanisms that expand these past ideas that we have encoded into law that speak to the responsibilities of custody. And that's always overlooked, and I think that's never discussed.
No.
So because we just assume that the laws that we wrote when people were riding in buggies still apply to very advanced technologies. And that's the other thing at some point in time we should talk about, like all these definitions that we created in the past, or definitions around what constitute money, they don't apply anymore. Right?
No.
When the world changes, you need to come up with new definitions. Don't cling on to things like the Howey test that speak to an orange grove farmer in 1946. It's not helpful. Don't cling to constitution, try to interpret that. Just be practical about things. Right?
Okay. Well, who determines whether or not, or who determines who changes those laws or those regulations? Huh?
Congress, for the most part.
All right. And is there a voice for our people yet?
Yes. So
blockchain
there's a somewhat flimsy proposal put forth to Congress by two congressmen, bipartisan proposal that addresses tokens specifically.
Okay.
It seems a little thin. I've reviewed some of the international proposals specifically for Switzerland. They're way more comprehensive. They would be well off just looking at the examples that we have internationally, and there have been already great public testimonies that have been given like as far back as 4 or 5 years ago.
Wow.
In front of Canadian Congress by very versed experts that should be taken into consideration that I transcribed. But again, it's moving way too slow, and it's probably fair to say there's a lot of entrenched interest legacy players in the financial space specifically that are trying to throw a wrench into that.
Yeah, I was about to say there's probably people that are fighting against this that don't want to
spreading misinformation, right? Pronouncing that they're doing blockchain and tokens when they're doing neither blockchain nor tokens. They're just trying to co-opt the term and make it less meaningful than it is. Right? Yep. Well, let's rein it back in and talk about specifics. So when I went before we went on a tangent, back to our hero here. Secondary trading, right? This is kind of where we're stuck. Secondary trading is hardly existing. So one part is a lot of these initial security tokens that were created under, let's say, Reg D and other prohibitions that would lock these instruments into the initial buyers. And there's very few exemptions that we don't have to go into when you can actually transfer those like to family members and so forth. But for the most part, these are stuck and locked for half a year to a year. And even those that are now coming out of this lock, they are limited to a handful, not even a handful, it's 4 as far as I know, alternative trading systems, because thus far there's no exchanges, public exchanges, where you would just be able to list these tokens, right? So
really?
Yes. So you can't, for the time being, you can't list it on Binance, you can't list it on GDAX, you can't list it on any of the top exchanges. So you got a couple of small, they're called ATSs, alternative trading system, which is a derivative of a broker-dealer, which is Templum, SharesPost, Open Finance, T0. And T0 just came online like 3 weeks ago.
What is it?
T0.
T0?
Yeah, Overstocks.
Okay.
And so they just came online. But, I mean, obviously there's nothing listed. I mean, nothing out of log listed there. Seems to be more likely that other jurisdictions going to be jumping over these hurdles much faster, because Gibraltar Stock Exchange has announced that they're going to do a partnership with Binance, and Binance for the time being has the largest liquidity as far as having buyers on their platform.
Yeah.
That then could presumably move into these additional assets over just quote-unquote cryptocurrency trading.
Yeah.
Again, yet another awful term.
An awful term. Cryptocurrency.
Yeah. So we got a bunch of, most of them call themselves platforms. I think some got a little smarter, stopped calling themselves platforms that do security tokens, right? Won't name any by names because it's shifting. For the most part, in my opinion, if you call yourself a platform, what you're signaling is you have nothing to do with the blockchain. You're some form of sidechain at best. And then the question always that you should be asking is, are you working towards a public blockchain protocol? Because it comes down to, if I need to join their platform to sell this, so you and me both need to be listed to their platform, what's the incentive of that particular platform? And usually the answer will be, we are yet another rent-seeking data silo, which is the opposite of blockchain, needless to say.
Yeah.
And even if that's not the case, if this particular platform goes away, right? Again, comes back to most of these guys are startups. If it goes away, what happens to that instrument that presumably could only trade there? So you want to be rather careful with who you engage with there. Then compliance. There's all these additional companies that sprung up in that space, which is rather curious because at the end of the day, this is probably going to move to the topic of self-sovereign identity and will be attached to that, and that's how it should be. It will take some time, so intermittently there's utility for these compliance providers. So you saw that with all the ICO platforms, like the people that provide KYC and AML and accredited investor check. And so, yet again, these are rent-seeking entities. Obviously, they provide utility, but these, again, are only needed if you treat it like a security. And it's actually, and that's something I've been saying for 2 years, it's actually obviously backfiring if you apply these trappings to something that you specifically pronounce to be a utility token, because a typical example is if I buy a blanket from you, you don't need to know who I am, right? So if I buy utility from you, chocolate from you, then you don't need my passport, you don't need my driver's license, you don't need to do an accredited investor check. So if I still require that, then it makes it very easy to say for any regulator, oh, you assumed that was a security, right? So and that was a really big issue I had all of last year when I sat in meetings with law firms that just said, oh, basically just do that. I'm like, no. At one point in time, I was a state prosecutor, and that's a really easy thing for me to jump on because it reverses the burden of proof, right? Basically, if you treat it like a security, yeah, then you got to prove to me now that it's not a security because, well, you did all the things that only securities require.
Wow.
And again, just very, very bad advice for the most part. And this comes back to the interest of legal consultants in the United States is never, almost never, I don't know of any case off the top of my head, aligned with these projects, right? I get a retainer and they tell you for $50,000 all day long what not to do. Well, what not to do is endless. You can talk about what not to do.
What to do is endless, yeah.
I probably did a couple of things on the way to work this morning that I shouldn't have been doing. But
yeah.
The point there is, ideally what we'd love to see for the US specifically and other jurisdictions, that's already the case, is where the interest is aligned of compliance providers and legal consultants in that space with the projects. And that's rarely the case. So if you can find someone, that's the type of entity you should be seeking out to create your particular instrument. So if these companies insist on whatever, charging you by the hour, charging you a fee every time for a transaction, that's, to us, it's a red flag, because that's the opposite of what blockchain is all about. Well, I can just keep talking for hours, as you know, without you asking me any questions. So we talked about custody. So until fairly recently, custody was a very expensive topic. What do I mean by that? So people still, for the most part, feel insecure to hold larger value items by themselves, like related to just, let's say, their laptop, their phone, or some other instrument. So if
you can lose that, they can crash.
And so if it comes down to having hundreds of thousands and millions of digital assets, then oftentimes people will look for a custodian. And so a couple of companies have specialized over the past couple of months on custody for this particular space. What's interesting to me is that, having come from kind of a data center space, like we built data centers like 20 years ago, you got most of the trappings that are associated, obviously, with keeping data secure. At the end of the day, this is all data of sorts. But this is actually way more convenient because it's smart data, right? So you can actually associate other trappings to the data that you're storing, because before that, and that's a typical example that people make. Before that, you had all these honeypots, and as long as you got into, let's say, the server, oh, you had access to all the data, right? As long as I social engineered the security guard and got into the data center, I could as well get access to everything that there was around. And that's why when you go into a typical data center, you got your biometric, and you got armed security, and you got cages within the data center and whatnot. But so if you then on top of this have a smart security, all of that particular function actually makes it much easier than what we had available to us to secure data in the past. Nevertheless, until very recently, it was tremendously expensive to host your digital assets or have give custody of your digital assets to any of the other companies, because it was, to the outside world, such a new topic.
Yeah.
Now, for the first time, we saw a couple of offers that are actually becoming more affordable, to where it's free with the caveat of once you move it, there's a fee attached for that movement.
Okay.
Kind of like your bank account, right? But we see it come down. There will still be custodians necessarily for institutional investors and so forth that don't want to just simply carry that risk, right, of needing to instruct everybody this is how we maintain these particular assets. So they want an outside entity. So there will still be cost and limited availability in that particular space for some time to come.
Yeah, like we're specifically talking about like things like Coinbase, right?
Coinbase introduced custody, and then you got Kingdom Trust was one of the early ones, Prime Trust, BankX.
And most people use Coinbase because it's one of the easiest ways to get into getting your first Bitcoin.
If it comes to cryptocurrencies, again, terrible term, but yeah, cryptocurrencies.
Terrible.
Number of cryptocurrencies we need, anywhere between 0 and 1. So, but in kind of, I don't know, almost closing here, the important thing to summarize, to understand is, if as long as there's no security token protocol on any of the public blockchains, on Bitcoin and on Ethereum or USIO, you can't really call something a token. Okay. And there's a couple of meek proposals out there on Ethereum right now. One is EIP 1450, one is EIP 1462. But they're still early, still very rudimentary, and at the end of the day, it only solves half of the problem, if at all, because it's a key lock system to where you, as a person or the entity that wants to acquire these particular securities, needs to fulfill certain criteria. So as long as I don't have that criteria, so specifically identity solved on the public mainnet, then I can't actually assign any of the digital securities to you, because otherwise I'm still confined to going back to some form of data silo that checks that you are not of a nationality that's not allowed to acquire these securities, or that you are an accredited investor, or whatever it is. And so these controls are years out. Comes back to the same topic. There's a couple of meek identity proposals out there, and that's something that we are revisiting right now, because it's an even more important topic to solve that, solve an identity on public mainnet. And that should actually, and obviously, be the step before you're getting to securities, because you can have a security token, but if you don't have anything to associate it to on public mainnet, then I'm back to square one, right? So I still have to engage with some form of data silo that checks for the prerequisite of you being able to buy that and pay for it.
Wow. So much stuff to get through just to...
Yeah, and a lot of these things, if you take a step back, are common sense, right? I mean, to me, it doesn't seem to be all that hard to understand. The problem is that I always say that reality doesn't have an advertising budget, and there's a lot of advertising out there where people throw terms around in the hopes that they stick because they sound good at first.
Yeah.
And you put a couple $100,000 in marketing out there and create some graphs, and then whenever the hard questions come up, you do some hand wavy thing. That's what we typically experience. And so you should just ask the hard common sense questions. Like the first one always is, if you're the issuer, so the person that's interested in creating a token from his asset, his company's equity, then your first stop is probably not how do you technically do that. Your first stop should be how do you create liquidity, meaning how do you sell this to people, and if you sell it to people, how much does it cost me, right? So, and if you can't answer that question, then just move on.
Well, I think some of the problems that we're having is that this stuff is created by kids that are they're very techy. They're not so up on regulations and laws.
Yeah, unfortunately, a lot of these people are very seasoned professionals that still get too enamored by vocabulary and technology at this point.
Yeah.
And they don't take the time to take a step back, because at the end of the day, they're not doing themselves a favor, and they're not doing this particular topic a favor, because it can only backfire. Whenever you overpromise, underdeliver, it's going to backfire.
Oh, yeah.
And we slowly start to see that, because I don't know if I was the first one to push back on this topic, but I, as usual, was one of the more vocal ones, and just said, well, you can't stop saying things like you tokenize a real estate, right? You don't tokenize real estate.
No.
You can only tokenize something because it's a technical term that is already digital in nature. You need to realize what a token is in the context of blockchain, right? So it's a smart contract that's based on a particular protocol.
Yep.
So not just a smart contract.
Right.
But the point there is like there is value to be had, but phrase it in such fashion that you communicate what the value is. Like you can reduce the cost of compliance, and that's why I prefer the term RegTech, and even over things like a lot of teams now have come a little bit more towards our way of thinking and calling things like a digital security. But at the same time, it's like, well, my shares that I own in Apple and other companies, they were always digital as far as I remember. I never got a piece of paper in the mail, so you're not actually making a distinction and difference at that point in time, calling it that. It's like, well, so what's your point there? It's a digital security, okay? Yeah, it was very digital yesterday, just like currencies, right? I mean, currencies were mostly digital for a long time, like
a very long time, yeah. Wow.
So you're not saying anything. Try to say something, not make a difference. Define it.
All right. So we have some other shows that coming up with more. More on this to break these down, so that
I need to understand in detail where we are today with identity. We looked at this topic exactly a year ago and decided to put it to the side, because from an allocator's perspective, it was just not interesting. It was just not timely. There was no way of telling what would find adoption and inroads. Early on in revisiting that topic, it still doesn't seem to be all there.
No,
unfortunately. But if we can get enough content around it, we should do a separate show. But the other one, really, I think, find important, and we're gonna tease out, is this topic of money and currency, because and there it comes back to money and currency are not the same thing.
Let's make that happen. All right. Well, good show. I'm sorry that we've had to do this a couple of times, but at least this time I think it's a little clearer, and we've got a producer on set with us that made sure that everything went smoothly. And with that, thank you for the education on this, and hopefully that everyone gets a little nugget of knowledge from this. And if they want to get any more, if they want to dive into this a little deeper, what do they do?
Go on Forbes.com and look for security tokens. I wrote an article that teases the protocol part of this out a little more. The last article I wrote, there was on money over IP, which is something
MOIP.
MOIP, which I find super interesting, and I think more interesting than cryptocurrencies.
Okay.
Real technology.
Forbes, and that's your buddies, right? Because you've given them a couple of stories, right?
Yeah, I try to get something out there at least every other month if I have time, once a month.
All right. Good. All right. From Sustany Capital headquarters in Orange County, California. Thanks for the information.
Thanks, Steve.
All right, man.